Hello, investors, and welcome to Stock AI Insights. Today is March 26th, 2026, and we're diving into a really dramatic day on Wall Street, one that saw a major index plunge deep into correction territory. Let's get right into the action. Yep, you're seeing that right. The tech-heavy Nasdaq is now officially in a correction that's more than 10% off its recent high. So what was the catalyst? Well, a sudden flare-up of geopolitical fear sent a massive shockwave across global markets. And just before we dive deep, a quick reminder, everything we're about to cover here is for educational purposes only and is not financial advice. Okay, let's get to it. So what exactly lit the fuse today? Well, it all traces back to escalating tensions over in the Middle East. And that uncertainty, it just sent this huge jolt through the global energy markets, and it basically dragged almost everything else down with it. And believe me, the sell-off was broad. I mean, the S&P 500 dropped 1.7%, the Dow lost a chunky 470 points, but the real epicenter of the pain, no surprise, it was in the tech sector. That sharp 2.4% plunge in the Nasdaq is what officially tipped it right over the edge into a correction. Now, what added fuel to that fire were some comments from former President Donald Trump. His remarks were probably intended to calm nerves, downplaying how important the Strait of Hormuz is for the U.S. But the market read it completely differently. They saw it as a sign of prolonged instability, and that sent oil prices spiraling even higher. And that spike was immediate. Brent Crude, which is the global benchmark, it just blew right past that critical $100 a barrel mark to hit 101. And that right there instantly reignited Wall Street's number one fear, persistent, sticky inflation. You could see that fear ripple through literally every other asset class. The 10-year Treasury yield jumped up to 4.43% as investors started pricing in higher for longer interest rates. Capital just fled to the safety of the US dollar, while the riskier assets, things like gold and Bitcoin, both saw some pretty significant pullbacks. Now, here's where it gets really interesting. This geopolitical shock created this clear and dramatic divide in the market. We saw a massive flow of capital out of certain sectors and pouring directly into others. Let's break down what that looked like. The divide was just stark. I mean, you're looking at a sea of red across the board, and the energy sector stood completely alone, finishing up a healthy 1.8%. It totally decoupled from the rest of the market, where you had those high-growth areas like tech and communication services just leading the decline. What we saw play out today was a textbook risk-off rotation. Investors were just fleeing from those high-growth, high-valuation sectors and flocking to what they see as safe havens. Money poured into defensive areas like utilities and consumer staples, and of course, into the day's undisputed winner, energy. Okay, so let's zoom in from the sector level to the specific companies that were making headlines, because believe me, the individual stories today were just as dramatic as the big macro picture. Man, it was a day of extremes. On one hand, you had Brown-Forman, the maker of Jack Daniels, soaring 15% on an acquisition rumor. Then, at the complete other end of the spectrum, furniture maker MillerKnoll got crushed, down 22% after blaming the Middle East conflict for its weak guidance. But really, the two stories with the biggest long-term implications came out of big tech. And this is where we really need to dig in a little deeper. A landmark lawsuit against Meta and a new technological breakthrough from Google, they didn't just move their own stocks. They sent tremors through their entire industries. So first up, Meta and Alphabet. A jury in Los Angeles found that features on platforms like Instagram and YouTube were a substantial factor in causing mental harm to users. This verdict sent an immediate chill through the entire social media space. And this is the question now ricocheting across all of Wall Street. Is this a big tobacco moment for social media? And what that really means is a fundamental shift, a point where the core business model, which is built on engagement and algorithms, is now seen as a massive legal liability. We're talking about a future with potentially endless lawsuits, heavy regulation, and frankly, a complete reevaluation of what these companies are even worth. Now for the other major tech story. Google unveiled this new software technology called TurboQuant. To put it in simple terms, it's a way to dramatically reduce the amount of memory an AI model needs to operate, making everything way more efficient. So you might be asking, why would a software innovation cause hardware stocks to crash? Well, The market's fear is simple, and it's brutal. If AI models suddenly need 6 times less memory to work, what does that do to future sales of physical memory chips? Investors are betting on a massive drop in demand. And that fear is exactly why SanDisk plummeted 11% and Micron fell nearly 7%. With all this chaos swirling around, what was the smart money doing? Let's take a look at how institutional investors and even everyday retail traders were positioning themselves during this big sell-off. So, today's big rotation isn't happening in a vacuum. The big money was already getting ready for this. Recent filings showed legendary investors like Warren Buffett trimming his huge Apple stake to add to the energy giant Chevron. The trend was already in motion, a clear shift away from mega-cap tech and towards tangible assets and energy. But perhaps the most telling signal of the day came from retail investors. For the first time since November of last year, they became net sellers of stocks. That relentless buy-the-dip optimism that has defined this market for months, it finally cracked. And that is a potentially major inflection point. All right, so let's put all these pieces together. The oil shock, the sector rotation, the institutional positioning. What does this all mean for the path forward? While the expert consensus is definitely pointing towards caution, BlackRock is out there warning of a disconnect between these high stock prices and the harsh geopolitical reality on the ground. Charles Schwab pointed out that market health is poor, with very few stocks actually participating in the upside. So the key takeaway here is that we're moving into what you'd call a tactical defensive phase, where resilience and cash flow are king. So what should we all be watching? 2 data points are now absolutely critical. Tomorrow, Friday, we get the final consumer sentiment numbers for March. That's a key gauge of inflation expectations. Then, early next month, all eyes are going to be on the PCE inflation data to see if this energy spike is already bleeding into the broader economy. AI analysts' bottom line: a geopolitical shock just poured gasoline on a market rotation that was already simmering under the surface. So, with fear rising and capital rotating, the big question for all of us is this: is your portfolio positioned for defense, or is it ready for a rebound? What's your take on today's price action? Let us know in the comments. Thanks for watching, and I'll see you in the next update.